Hello everyone. Imagine a financial landscape where half of the companies lining up to raise capital are burning cash at an unprecedented rate. We are looking at a combined loss of over 12,000 crores among the India's hottest IPO bound startups. Yet, institutional investors and mutual funds are deploying capital into these entities faster than ever because they have no choice. The liquidity flood is forcing their hand. But across the ocean, the narrative flips. An AI giant just proved that you can deliver massive growth alongside massive profits, surging 77% in revenue. So, are the Indian market participants trapped in the liquidity bubble, or is this the cost of buying into the future? And what does the SoftBank's recent 700 million hit tells us about the risk lurking in our own backyard? We will decode the profit and loss paradox in today's session. Hello and welcome to the Nifty 50 Post Market Analysis. I'm Ajay Ikka, and today we are looking beyond the closing bells and the daily index movements. We are dissecting a critical divergence in the market sentiment. On one side, we have a global tech explosion led by genuine earnings and AI based profitability. On the other hand, we have a flood of Indian startups heading for the primary market with the red ink on their balance sheets, yet commanding high interest from the fund managers. So, if you are a retail investor holding mutual funds or an arbitrageur looking for listing gains, you need to understand where the smart money is actually flowing and where it's getting stuck. The global benchmark Applevins AI dominance. Let's set the stage with a global cue. While domestic market participants often worry about technical valuations, a US based edtech giant, Applevin, has just rewritten the playbook. In their Q2 earnings report, Applevin posted a staggering 77% YOY revenue jump to $1.26 billion. Now, why should an investor tracking Nifty care about this? Because of how they did it. This wasn't a speculative growth. It was driven by AI powered AdTech engine. The market rewarded this execution instantly. Their stock spiked 4% during the session and the net income skyrocketed 164%. Unlike many AI plays that are purely conceptual, AppLovin is generating massive cash flows, boasting an EBITDA margin of 81%. The insight of market participants. Global investors are aggressively rewarding profitable AI implementation. Applovin is currently rated as a strong buy and attracting massive institutional inflows, sitting right alongside Nvidia and Meta in the mutual fund holdings. As we evaluate Indian IT and edtech stocks, we must ask, are our domestic companies showing the same kind of bottom line efficiency? The Indian dilemma, loss making IPOs and mutual funds appetite. Now let's pivot to the domestic front. The primary market is buzzing, but the financials paint a concerning picture. A recent analysis highlights a startling reality. Half of the new age tech companies gearing up for an IPO are currently loss making. We are tracking 42 companies preparing the list. Out of these, 21 have reported net losses, including the major names like Meesho, Flipkart, PhonePe, and Zepto. The combined loss of these 21 startups exceeds 12,000 crores. Yet, despite this massive cash burn, Indian mutual funds are participating. Why? According to the market veterans, it comes down to one factor: appetite. India is facing a scarcity of quality paper. There are only 275 companies in India with a market cap of above 30,000 crores. Meanwhile, SIP inflows are hitting records high. Fund managers are sitting on piles of cash with limited avenues to deploy it. Legacy stocks like HDFC or Infosys aren't offering that explosive growth needed to generate alpha. So, fund managers and institutional investors are forced to look at these loss making high growth disruptors. So, is it dangerous? It carries a significant risk. While venture capitalists argue that we should look at operating metrics rather than net profit, we have seen how this plays out. Remember the Zomato IPO? Mutual fund anchored 33% of their book despite the losses. While Zomato eventually found its footing, many early investors in the similar place faced volatility and had to make an early exit in losses. For the retail investors, this is a signal to be cautious. Just because a mutual fund is allocating capital to a loss making IPO doesn't mean it suits your risk profile. They have a 5-year horizon and the diversification. So, have you the same? This smart money signal, SoftBank's warning. Speaking of the institutional capital, we have a talk about the SoftBank. SoftBank has finally posted its first annual profit in 4 years, driven by global tech rally. However, there is a critical caveat for Indian market participants. While the Vision Fund 1 is profitable, Vision Fund 2 reported a huge investment loss of 708 billion US dollars. The primary culprit, the poor performance of Indian listed stocks, specifically Ola and Swiggy. SoftBank explicitly cited that the share price declines in these two Indian companies dragged down their performance. Ola Electric, for instance, has been losing market share to legacy rivals like Bajaj and TVS. The analysis. This is a flashing warning light. When one of the world's largest tech allocators take a hit specifically because of the Indian valuations, it suggests the listing power might be fading for some of these companies. It enforces that eventually profitability and the market share stability matters more to long-term investors than the initial hype. The conclusion and the strategy. So, how do the market participants position themselves tomorrow? The first one, follow the earnings. As seen with Aplaman, the market is rewarding high margin growth. Look for the companies with strong EBITDA margins, not just fake revenues. The second one, scrutinize the IPO. If you are an investor looking for upcoming tech IPOs, don't just follow the institutional herd. Check if the company contributes to that 12,000 crores loss bucket. Ask if they have a clear path towards the black ink. The third one, monitor institutional activity. Keep an eye on FII and DI holdings. Stocks like Delivery and Tata Chemicals are showing high institutional interest, signaling where the smart money is parking its capital. The markets are evolving, and the era of growth at all costs is being challenged by the demand for real earnings. Position your portfolio accordingly. So, before we close, a necessary disclaimer. Please note that all the specific company names, stocks, and the financial figures discussed in this podcast are strictly for education and reference purpose only. The content does not constitute investment advice or a recommendation of any sort to buy or sell any securities. Financial markets carry inherent risk. We strongly advise you to consult with a certified investment advisor to understand your personal risk profile before making the investment decision. I'm Ajay Eka, and this is Nifty 50 post market analysis. I'll see you on Monday morning. Bye bye. Take care.